The next speaker is Dr. Graham Voss. Dr. Voss is an associate professor in the Department of Economics here at the University of Victoria. He's going to be talking about the real economy and policy responses to the situation. Graham's principal area of research is applied macroeconomics with a focus on monetary and fiscal policies and exchange rates. Much of his work involves either assessments of macroeconomic policies or empirical modeling of macroeconomic behavior. He has also worked directly with private sector and government organizations, both here and in Australia, on policy-related matters such as public infrastructure spending, public accounts, and the interdependence of the Canadian and American economies. Graham? Thank you, Basma. Thank you very much, Basma. Our next speaker, Graham, would you mind flipping your... Perfect. The next speaker is Dr. Graham Voss. Dr. Voss is an associate professor in the Department of Economics here at the University of Victoria. He's going to be talking about the real economy and policy responses to the situation. Graham's principal area of research is applied macroeconomics with a focus on monetary and fiscal policies and exchange rates. Much of his work involves either assessments of macroeconomic policies or empirical modeling of macroeconomic behavior. He has also worked directly with private sector and government organizations, both here and in Australia, on policy-related matters such as public infrastructure spending, public accounts, and the interdependence of the Canadian and American economies. Graham?
Thank you. Sorry, I have to stand when I speak, I'm afraid. Well, good evening. So Basma's has given us a sense of the crisis so far, how it started and how it's evolved. And a lot of the discussion has focused on the financial side of the crisis, which is the side that gets most of the news, or has been getting most of the news through September and October. What I'm going to do is to try and connect how this financial crisis, this really credit crisis, which is where it started, has mapped over into the real economy. And in particular, I'm going to focus as much as I can on the Canadian economy. Now, a lot of the excitement, of course, is in the United States and in Europe, but nonetheless, there's a lot going on in Canada, and it's much more important to us personally, I think. The financial crisis, the meltdown, as the President's panel calls it, is really the defining event for the global economy, certainly in my career. This is an astonishing event. The speed at which it's happened, the volatility, the interconnectedness amongst the economies, and the way that it's moved rapidly around the world. This is something, as a number of people have already said, that we're going to be discussing for a very, very long time. More importantly, we're not just going to be discussing it, but it's going to shape policymakers and policies, both in Canada and globally, for many, many years to come. And another key aspect of what I want to speak tonight about is this policy aspect. The current situation in Canada is where I'm going to start. As the slide says, it's difficult not to be pessimistic. And I've been told that I'm a little too pessimistic. But nonetheless, what I want to do is take us through some of the data. I don't have a lot of time here, and it's hard to get some sort of pictures that really capture the situation. But I want to get a sense of the Canadian situation. One thing that we know, and the newspapers and the press have been passing on to us, is that the credit crisis hasn't been anywhere severe in Canada as it has been elsewhere, most notably the United States. And the explanation seems to be we have slightly better regulations for our banking sector, and we have a slightly more risk-averse banking sector. Nonetheless, there are lots of indications that credit is tightening up there. Credit conditions, both the quantity and the prices that are charged, have been tightening. At the same time, though, and it's quite remarkable, throughout, this crisis really started about in 2007, in the summer of 2007. And if you look at what happened to the United States in credit over that period, credit growth essentially collapsed. And that's really two sides of the thing. Lenders weren't willing to lend, and borrowers weren't willing to borrow. The household and the businesses were taking on a lot less debt, and they were just finding that debt hard to get anyway. That's not been true in Canada. So if you look at the data, you'll see that Canadian credit growth of households has been very strong up until August, September of this year. Canadians have continued to borrow and banks have been willing to lend to them. Credit conditions are a little bit tighter, but that's still been ongoing reasonably well. That's a remarkable difference between the Canadian economy and the United States economy. Ultimately, this is a credit crisis. It is global, but it hasn't really damaged, at least yet, what's been going on in Canada. So in that sense, we're a little bit different. But if we think about what this is going to mean for the Canadian economy, we're still looking at some fairly bad numbers. So up on the table, I tried to keep the numbers to an absolute minimum, but I'm an economist and it's very difficult to do. Up on the table, I have annual percentage change in GDP. I like the annual numbers a little better, then I don't have to get into a debate about what a recession is, okay? Annual numbers are nice little snapshots. And these are forecasts. We don't know what 2008 is going to be. We won't know until 2009. The Canadian forecasts come from the Bank of Canada, which are the forecasts I tend to trust. The other forecasts come from the OECD, and again, these are reputable institutions. So these are as good as numbers as I think you can get out there. They are, however, before I talk about them at all, they are, of course, projections. Okay? And one of the things about making projections or forecasts right now is there's a huge amount of uncertainty. This is very, very difficult, and some of the connections about how the financial crisis spreads to the real economy are very difficult to predict. So these numbers have to be, we've got big areas of uncertainty around them. But the key, of course, is that Canada looks a little bit better than the rest of the world right now. 0.6 in 2008, 0.6 in 2009, and back to average annual growth, which is 3.5% by 2010. I think that might be a little optimistic. But even though that looks nice, well, at least relative to the negative numbers in Europe and the United States and Japan, I can put these numbers in perspective. 0.6, those 2 years, they will be the 4th and 5th lowest annual growth rates that Canada will have seen in the last 50 years. The only other years that were lower growth than that were recession years associated with the 1982 recession and 1990-1991. So although it's not apparent in the British Columbia economy right now, things seem to be doing fine, although credit is growing fine, Canada is looking at a fairly severe economic downturn. And British Columbia, try and bring this back to home, is not going to be able to avoid that. So then what are the linkages? These numbers, these forecast numbers, are very much coming out of these institutions based upon their best understanding of how this financial crisis will feed into the real economy. So then what are the connections that we can look at? Well, the first is relatively straightforward, and it's one that's been hammered home to us in the media repeatedly over the last 2 or 3 months. Credit markets are the lifeblood of the economy. When firms can't borrow, they find in credit conditions increase, it's difficult for them to make payroll, it's difficult for them to pay suppliers. Similarly, when households can't borrow, they can't spend. All of that's going to contract or reduce the amount of spending growth that we have in the economy. So that's pretty clear. Again, so far, that's not necessarily a large problem in Canada. We are seeing some signs of credit strain, but nothing like elsewhere. So there's some other connections which are important as well. And the one that perhaps I want to spend the most time on is household wealth. Okay, what's been happening along with this credit crisis, of course, is a lot of volatility in the financial markets, as well as severe losses in the financial markets. We've also seen, even in Canada, a reduction in our #1 asset for households, which is, of course, housing. All of that's a drag on consumer spending because all of a sudden, you and I realize that the savings we thought were quite large are going to be less, and they may not be enough. So what you're going to see is households start to save more. That's certainly going to be true in the US. You can't save less in the US as far as I can see. But it's got to be true. Canada also has a very, very low rate of saving. Historically, it's around about 2 or 3% right now, household saving. And it's going to increase. That is going to be a drag on the economy. It's a necessity. Households have to repair their balance sheets. Right? The other somewhat more difficult and non-obvious effect of all of this is that, as I said earlier, this is a defining moment in the Canadian economy. A lot of us have never seen volatility in financial markets like this before. What we're now recognizing is that savings that we thought were relatively safe, a bad year, what, 1 or 2%, can be a lot worse. And what you're going to see out of that, or what I'm anticipating you'll see out of that, is a lot more savings than people would have otherwise done. There's a fancy name for it in economics, precautionary savings. But the bottom line is there's a lot more uncertainty. People recognize, certainly I do, that you're going to need more savings because these one-off events can take a lot of your wealth away. That's extremely difficult to predict how that's going to affect. That's not something we deal with every day. That's why these GDP growth numbers are going to be very, very uncertain. Lastly, there's the external linkages, and again, the table sort of points to the issues here. If major trading partners like the United States and the Euro area, Japan and Asia, which isn't on there directly, are growing very slowly, that does not bode well for Canada, which is a large exporting country and depends a lot upon trade for its growth. That's fairly straightforward. One thing to note, again, just to put that into perspective, that minus 0.9 for the United States, there's nothing in the US history, in the post-war history, really that comes close except for the 1982 recession. So again, we're seeing the United States go, and people are much more concerned about the US, going into a very severe recession. That doesn't even seem to be a debate anymore. So it's hard not to be a pessimist. But on the whole, I want to qualify this, so far, Canada seems to be faring relatively well. We are moving into this in a slightly less damaging way. Was that my warning bell? No, okay. When I say relatively well, I don't mean relative to other downturns. What I mean is relative to other countries. That's cold comfort. We're still going into a period of slow economic growth. Okay. And it's not surprising. We are basically being hit by three interdependent shocks, if you like, or events, all of which could cause a nasty downturn. We have a credit squeeze, we have a collapse in financial wealth, and we have falling global demand. They're all hitting us. They're hitting British Columbia just the same. I want to say, though, that things would have been considerably worse had policymaking to date not been quite effective. And now that's what I want to turn to, is I want to discuss the policy issues, which is really my primary area of interest, that have arisen as we've gone through this event, and more importantly, what we're looking at in the future. Policymakers are unbelievably focused on these events, in some important ways, they're not making mistakes that have been made in the past, which is partly why I'm reasonably somewhat optimistic about these things. They have three things they have to do. They have to restore the credit markets, they have to manage the economic downturn, and the one that's the longer term one is, as I say up there, there's this issue of financial market reform, which is going to be a huge focus for many, many years to come. I want to talk briefly about some of these aspects. The credit markets, it's perhaps something that academics get a little bit more excited about maybe than the general public, but the response of the central bank, most central banks around the world, most notably the United States Federal Reserve, have been quite remarkable. Now, we can debate about whether they started the whole thing by too low of interest, but their response to it has been unbelievably rapid, ongoing, and highly, I would say, imaginative. Essentially what they've done is, by hook or by crook, especially in the US again, they have managed to be a principal lender in credit markets which is seized up. Right? But central banks are supposed to be the lender of last resort. They've just taken on that role in an enormously huge way. And in the process of doing so, the Federal Reserve in the US has undertaken huge amounts of assets on its balance sheet, basically lending on its balance sheet, much, much greater than the $700 billion bailout which was organized by Congress. So they've provided this liquidity, they've injected capital in the United States. The same things have been happening as far as liquidity is concerned in Canada as well. Roughly speaking, if you want to sort of get a comparison of what the two banks have done, in the United States, the Federal Reserve has about $700 billion in a short-term loan program, which is out to their financial institutions. That's roughly what they have outstanding, similar to the US, the Congress bailout bill. They have other stuff going as well. In Canada, the Bank of Canada has been active since 2007 in the same way, providing credit and liquidity to the Canadian financial institutions, and outstanding right now is something like about $30 billion, or will be by the end of the year. So that's what's been happening in Canada. There has been a big effort by the Bank of Canada to try and provide this liquidity in the market. And if you think roughly about 10-to-1 ratio between the two economies, it's not quite right for the financial sectors, but you can see we don't have the same size of problem, but we're still, for the size of our economy, in a large way. Okay, that's worked quite well. That is my beat? Okay. The other aspect of this is the international cooperation that's gone on between central banks, and this is something I want to focus on now in my last few closing minutes. In past crises and past events, central banks have typically gone it alone. What we've seen in the last 2 or 3 months is an incredible amount of cooperation between the industrialized central banks as they try and present a united front. So they had coordinated interest rate cuts in early October, and they have major swap lines. Basically, they're willing to lend to each other if somebody's short of dollars, which is what it amounts to. The importance of this is not so much that these policies were undertaken, they would have been undertaken anyway. It was that they were done in a cooperative way, and it was really a design to boost confidence. And it's particularly true about the interest rates cuts. If the central banks are working together, then there's a much better chance of restoring calm to the financial markets as best as possible. I'm not saying they've done the job. Right? We still have a lot of volatility, but we would be considerably worse without it. Okay. The economic slowdown is relatively straightforward. I don't want to spend a lot of time because I've just been told I have to be quiet. But the story now is fiscal policy. Monetary policy has basically run its course. Interest rates, particularly in the United States, are now so low that there's not much more they can do. And now we're talking about fiscal policy, and we see deficits. And I hope there's some questions about that. I want to talk very briefly about financial market reform. This, as I said earlier, is going to be a principal source of debate and discussion, but it's incredibly important that there is this coordination and cooperation among the industrialized countries and now all the members of the G20 as they move forward to try and restore some sort of semblance of market order. The recent G20 meeting was greeted with a great deal of skepticism amongst academics and other people. It was very difficult to see that there was anything substantive going to come out of it. And in actual fact, there was some very, very important substantive plans laid for financial market reform. It was particularly heartening to see that amount of cooperation. There now seems to be a consensus on improving the transparency of the financial markets, harmonization of regulations. There just seems to be a lot of willingness, perhaps because of the size of the crisis, to proceed in this way. So that's quite good. And hopefully, again, we can talk a bit more about that. I do want to close on a bit more of this optimism-pessimism thing. One of the most worrying aspects about the situation that we're in right now, and the big lesson we learned from the 1930s, is that if countries, policymakers within countries, decide to pursue policies with a purely national agenda, and by that I mean protecting domestic industries, raising tariffs, restricting investment, then all of those projections that were up on the slide a minute ago are all completely wrong. Right? We know from the 1930s and other episodes that when countries pursue this fortress mentality with regards to trying to shore up their own economy at the expense of other economies, undervalued exchange rates and tariffs are the best examples, then what you get out of it is a much longer, much more protracted, much deeper recession. So that, I think, is the biggest worry the biggest worry I have about the current policymaking environment. On an optimistic note, one of the most pleasing things that came out of the G20 communique, which was issued after this weekend's meeting, was an explicit recognition by all of the members there that policies such as that, such as tariffs, restrictions on investment, and so forth, they all committed to not pursue those effectively over the coming months as we move into this global recession. That's an extremely important sign, and that leaves me some hope that we will come out of this in the future reasonably well. Thank you.
Thank you very much, Graham.